Many analysts have expressed the opinion that the only way for the US to deal with its debt problem is by inflating away its debt. Well, with US 10-year bond yields now below the US rate of inflation, it means that the real value of the debt is declining at a faster rate than the cost of that debt. For more on this, Adrian Saville from Cannon Asset Managers. Now, Adrian, right at the beginning of the show, I spoke about the fiscal cliff and possibility of a European implosion, but I know that you have this acronym about the sky not falling on our heads or something. What is that?
It's called SINFU,
yes,
which says the sky is not falling on our heads. That's the acronym.
Is that your central thesis?
Well, no, the central thesis has actually got two legs, and the one is, it's one that we call PAFTOTI, which I don't think I'm allowed to repeat on the show, but essentially it implies that the advanced world is going to push the deck chairs around and rearrange the furniture for a very long time. Quite how long is... I think that would be brave or bold to forecast an exact figure, but we think that this is a multi-year, possibly even a multi-decade rearrangement of the furniture.
Does this make your job easier or tougher? Because we keep hearing, right? More of the same, low yields, low returns on equity as well. So surely you could just buy an exchange traded fund and go and sit on the beach.
If only it were that easy. Look, I think it is more complex because first the dynamic is this, that the old engines have shut down. And the old engines being North America, Japan, and Western Europe. They've shut down. Their debt, I think, is very poor quality. I'd be as bold as to suggest their debt is junk, government debt. Their economies are very sluggish, and they're going to remain that way for some time. And they've got structural issues hanging around them, for instance, aging populations, which means not only is the nature of the workforce changing, but the nature of their production and consumption patterns is changing. That makes it more complex. In the same breath, world economic growth hasn't, well, we're going to talk about the cliff in a moment, but world economic growth hasn't collapsed. The world economy continues to go forwards, and it's being driven by new engines. BRICS are often volunteered as the key drivers, but it's much more than just those four economies. We're talking about 180 economies, and you've got the likes of Chile and the Philippines that this year have put together 7-8% economic growth. The challenge here is they are new engines.
Mm-hmm.
So, Adrian, how do we get our heads around this fiscal cliff? I just want to touch on this before we talk about some of these frontier markets and horizon markets and the different names that come after the BRICS. The U.S. fiscal cliff. They upped their credit card limit a year ago. Now comes crunch time, and thank goodness they weren't having to negotiate this around the presidential election. But they've got the choice now of getting together and structuring a new deal to put them on a new path around how to control their debt, or unless they don't get the deal done, there are mandatory adjustments that are made. So what's your sort of take on how this is going to play out and what it means for the US? Because it has been alluded that they will be the first major economy to emerge from their debt crisis, if you can call it that.
Yeah, in a short space of time, it's hard, I think, to pull away all of the subtleties. I think it's an extraordinarily complex problem. But a few strands that I would pull out. The first one is that the United States, whilst it is saddled with this very large debt in the same way that Europe is saddled with large debt, the United States has managed to resume its growth trajectory, which implies that they are in better economic health structurally than Western Europe. Not great, but better. It doesn't change the nature of the debt, and the debt isn't just things that they've built up in the past. The debt is also made up of promises that have been made. If you get sick, if you're unemployed, if you go into retirement and you don't have sufficient funding, the state will look after you. These are very big obligations on the part of any government, and it calls into play a pay-as-you-go system. So there's a temptation to argue, I think, that you can inflate this away. But if you inflate away pay-as-you-go commitments, it just requires you to pay even more. My inference is then that they have to change the social arrangements and the political arrangements. What I mean by that in simple terms is retirement age goes from 60 to 70 or 65 to 75, that funding commitments for unemployed or for sick fall substantially lower, or for shorter periods if you're unemployed. These are significant political challenges, but they're going to have to be faced.
We as journalists love to publicize this fiscal cliff, but what does it mean for companies operating in places like the US and that are listed in places like Western Europe? Is there an implication that's coming for the companies in terms of the return that they can generate, as well as what it means for investors buying those shares?
Warren, I think that there's two elements. The one is that the fiscal cliff has a taxation side and a spending side. So we need to figure out, which part of those, or both, is going to hit a sector in the economy or companies. And the consumer will be obliged to pay higher tax rates, and the economy is also going to have less government spending to fuel or lubricate the system. Some of the numbers that I've seen suggest that economic growth could be lowered by as much as 3% as a result of the fiscal cliff, and that unemployment in that event goes higher. That will have a negative impact on economies and on companies. In the same breath, if this is already in the price, then there may actually be some really good opportunities in those environments. And the United States and Western Europe, I think, both come with some fantastic opportunities because investors have become so bleak about the prospects for the advanced world. They've more than priced the bad news in.
So for a deep value investor like yourself, a contrarian investor, obviously a starting place, I imagine, would be places like Europe. Japan's come onto the radar. Where are you seeing some value, and where are your investing activities taking you to find some of these attractive regions?
In the global environment, the types of companies that we find particularly interesting are companies that are sitting on, first, as a point of departure, undemanding multiples, that they've got low valuations relative to their earnings, they're paying attractive dividends, businesses of quality, strong balance sheets, good cash flow. Because if the environment lingers, they've got to be equipped to deal with this.
For you, is that still pharmaceuticals? A while back, that was where you were looking.
There are some really interestingly priced pharmaceuticals, but it goes beyond the pharmaceuticals. On a few occasions, we've spoken in this studio about the likes of BMW on single-digit earnings multiple, yet they've grown their vehicle sales 25% in the last 12 months, helped by the new drivers. Their volume in Southeast Asia was up 40% last year. So they had their most profitable year ever in 2011, yet investors priced the stock down 30% through the course of the year. To us, that's a really interesting opportunity. It sits in a competitive economy, Germany. It's got a world-class product backed by a fantastic brand. The balance sheet is strong, management is exceptional, and you're not paying lofty multiples for the company, and the earnings are growing. Intel is another case in point, and you're doing the advertising with your laptops this evening. Samsung is another case in point where the companies just aren't priced for the results they're producing and their prospects.
So by contrast, what you might be getting in the South African market is far less attractive.
Sure. And if you look at some of the valuations in the South African market, I wouldn't say that they're demanding. I would say that they are beyond demanding,
yes.
Dangerous.
Warren, you referred earlier to frontier markets. So we see a lot of that appetite amongst global investors, but that's driving some of our multiples because yes. Those companies present here are expanding onto the continent. So you're not necessarily then seeing the opportunities.
Well, I think the part of the South African market that has become really stretched is the headline names and larger companies, because larger companies can receive capital from international investors. You can buy 20% of a 100 billion company with dollars. So it's the large companies that have received attention, and it's the large companies that have profile that says we are engaged in the new consumer, yes. African drivers, even more than just South African drivers. And here, I think the suspects are the likes of Mr. Price and ShopRite.
Yes. Adrian, we've got to say goodbye. So in 20 seconds, what's your message to investors?
I think the message is, as always, look for the opportunity, because markets are crazy, markets are inefficient. And in the South African environment right now, fantastic opportunities in industrials and commodities.